every year from the external sector in economy, we are getting roughly 3 to 4 questions. So that makes it a very high yielding topic. So welcome to this second video of our high yielding series where we'll be talking about the balance of payments, imports, exports, trends, and the associated concepts from which we can expect 3 to 4 questions. When we are dealing with the external sector, the first concept that we need to know is the balance of payments. I'm not going to explain this topic in detail because I've already done so in the crash course last year. So if you're not aware of what balance of payments is all about and what current and capital account means and what are the components, please go back to that video and have a look. One expected question from this chapter: income terms of trade. What does it mean? Basically, it's a ratio. Ratio of what? Price of exports and price of imports. So there is an elaborate formula for this income terms of trade as a term. We are not getting into the definition and the formulae. Basically, UPSC has a tendency to ask trend-based questions like, if this increases, what happens to another parameter? So taking that format of questioning into line, we are trying to understand how income terms of trade and export prices and import prices vary. So let's say, for example, if the metric ITOT is increasing, what does it indicate? It indicates that the price of the exports is actually increasing, and this is a positive development. And if that is not the case, it is decreasing, then it means that the export prices are not increasing in proportion to the prices of imports. It does not mean that export prices are reducing. Okay, it just means that the rate of growth is very slow. So this is a negative development because we have to export more to maintain the same level of imports. This is not improvements. Please correct this. So where is this ITOT as a term important? You know, the GDP formula is C plus I plus G plus X minus N, and this talks about the trade. So for countries which are significantly dependent on international trade, this becomes very important. So you have to understand the term and how it can be asked in UPSC Prelims. So this is how it can be asked. In the past, Prelims paper had questions from economic survey based on trends. So I'm taking data from the economic survey of 2023 and prepared this slide. So please go through this. What are the top exports of our country? Petroleum products. Now, a lot of freshers might make a mistake here. We know that 87% of the crude oil is actually imported from elsewhere in our country because we don't have the reserves in our country. But it does not mean that we can't export petroleum products or the products that we get after refining crude oil. India is a refining hub, the fourth largest in the world after US, China, and Russia. There are 23 refineries in our country. Most of them are public sector units only. We also have a very large oil refinery coming up in Ratnagiri near Maharashtra. That is why this is in news and I'm discussing it. After petroleum products, we have jumps in jewelry, organic chemicals in the next 2 spots. As far as agricultural products are concerned, the first product is marine products like fisheries, etc. And then non-basmati rice followed by spices. So you have to remember this order. Please pause the video and you can write down in your notes or just remember this order. Now coming to services. Which products or which services do we actually export more? Obviously IT and telecommunication. Then we have at the second spot transport and then travel. So just remember this. You also have to remember that financial services, which is the emerging sector in the services sector, has a huge potential for exports. Please focus on this. Or in the future, any initiative taken to improve the financial services exports is going to be important. There are other important areas in this topic, but I'm not going to read out the slide. Rather, what I would do is I'll help you remember the most important key trends which can be asked in the exam. As far as imports is concerned, we know that it is crude oil followed by gold. Nothing much to remember here. And as far as the services sector is concerned, we also import services. A lot of freshers make a mistake here, thinking that there are absolutely no services which we import. That's false. As far as the export and import destination and sources are concerned, USA is the major trade partner where we export most of our services and goods. And as far as imports is concerned, we know that China is the major hub where we import our goods from. Based on the budget 2023 declaration or the announcement that India will now encourage lab-grown diamonds, that is sustainable diamonds, which are ethical in nature because they are not obtained by child labor and other cruel practices followed in this industry. We have to understand that Hong Kong is the major import source for our diamonds. Another important country as far as our imports is concerned is Indonesia, where we'll get from uh, palm oil. Mostly 50% of our edible oil is imported from elsewhere. So you have to comment in the comment section below, what step did the government take to address this issue? The next one is migrants. Most of our country people are now migrating to the West developed world, where the demand for high skilled jobs is higher. This, when you compare with the trend where people used to go to the Gulf for low skilled jobs, is now changing. That is the trend you have to remember. As far as diaspora is concerned, we have to talk about remittances. Remittances are still very useful for maintaining foreign exchange reserves and to arrest the fall of rupee depreciation. Recently, the government decided to increase the limit of transfer without any permission from NRIs to India up to 10 lakhs. Recently, Pravasi Bharatiya Divas was conducted in January 15th. What is the importance of this date? Please post in the comment sections. So this year's theme focused on how diaspora can be important for India's progress in Amrit Kal. Now, the next policy that we'll be talking about is the foreign trade policy of 2023. You know, growth is defined by this formula C plus I plus G plus X minus M. As far as external sector is concerned, we're talking about this trade. Foreign trade policy becomes very important when we're talking about this trade. And the objective of this foreign trade policy is to ensure that we reach a target of 2 trillion US dollars through exports by 2030, and it rests on 4 different pillars: tax remission, ease of doing business, focusing on the needs of the emerging sector, and collaboration with various stakeholders in our country. As far as tax remission is concerned, it basically means government will try to subsidize companies by paying back the duties. There are various schemes for that: ROTTEP, EPCG, and advance authorization. You don't have to go into the details. As far as the ease of doing business is concerned, this is a very significant step. These incentives are given to export. But if exporters do not fulfill that obligation, they are penalized. Now, as a part of this foreign trade policy, there was an amnesty scheme, or the government is letting go of the defaulters to encourage business. That is one scheme that came here. It's important. Now, as far as the emerging sectors are considered, there are certain sectors, like one list called the SCOMET list, which has special chemicals, organisms, materials, equipment, and technologies which are slightly dangerous. Though they're dangerous, they have a lot of potential. So the government wants to focus on this SCOMET list. And there are some technologies called dual use technologies, which can be used for good and bad. For example, drones. They can be used for, let's say, in agriculture, and also can be used in terrorist activities. So high-end goods of dual use technologies will also be focused in these emerging sectors. And the next one is e-commerce. So in the customs department, there is a portal called IceGate. Here is where most of the customs work happens for export clearance. So in order to facilitate e-commerce growth, foreign trade policy addresses this e-commerce sectors. The details are not important. And as far as collaboration is concerned, it's simply about taking the lower levels of governance into consideration and confidence. At district level, now the Ministry of Commerce officials through DGFT officials, they will be collaborating with the district level collectors. They'll identify products. This is where the famous one district, one product scheme comes into the picture. And the government announced that district export hubs will be encouraged. So training will also be provided for these exporters to ensure that markets are explored. So these are the basic pillars on which you have to understand the foreign trade policy, nothing much. Now, what does the Economic Survey 2023 say about how to increase exports? Reduce the logistic cost. This means we have to invest in our infrastructure, improve the efficiency of our warehousing capabilities, etc. Basically, for this, you have the National Logistics Policy, which was recently brought out, and certain actions were laid down. That will be discussed elsewhere in the mains videos at a later point of time, which is not important for our prelims exam. Second one is signing and implementing those free trade agreements. Okay. And the third is we have to focus on high value exports. This is what the economic survey says. And also mentions about how Bangladesh and Vietnam are potential competitors for India, but eventually India will outsmart them because of our sheer size of the market. Bangladesh is competing with us with textiles, and Vietnam is competing with us in terms of manufacturing, that is machinery, or whether it is computers or electronic products. Apart from this, questions can also be asked with respect to the free trade agreements in news. India signed a free trade agreement with UAE, SEPA, and with Australia, we signed an economic cooperation and trade agreement. One important fact that you have to remember here is India did not have any clause which talks about investment protection. Any chapter of the trade document does not deal with this investment protection. Even in the past, India was very apprehensive about investment protection clause. That's why it did not join the RCEP also, which had these investment protection clauses. As a part of this deal, India will have access, that is tariff-free access to 100% of the discussed line items in this deal, and Australia will have up to 70% of preferential access. Also, it is in this context, it is discussed that India should try to become a member of APEC. Now, what is this APEC? Who are the members? Please post in the comment section. Regarding the developments of the current account, we are done with it. Now we are talking about the capital account. Basically, capital account involves those transactions which create a long-term liability. The first one is FDI and FPI. What is FDI? If the investment is only in equity by a foreign entity with a objective to gain control over the management or the production of an economic activity in an Indian entity, that is called FDI. If it is less than 10%, that is called the foreign portfolio investment, and it can be either in the form of debt and equity. Recently, to increase foreign exchange reserves or US dollars inflow into our country, government announced that even in G6, that is government securities also, foreign portfolio investors can invest. So if you take a look at how foreign portfolio investors behaved during the time of pandemic in the last couple of years, you would notice that as soon as the lockdown is announced, they left the country by selling their assets. Slowly, during the peak of COVID lockdown, we have seen an IT and pharma boom in our country, and therefore they came in for profits. Eventually, with Ukraine and Russia war, and also US Fed announcing that it is increasing the Fed rate, so they removed that money from Indian markets and went back to US. So that is why you will see that severe decline in the foreign portfolio investments. This is the trend about FPI. We'll also have to talk about FDI. Major sources of FDI: Singapore, Mauritius, UAE, USA. It keeps on changing every year. As per economic survey this year, it is Singapore, followed by Mauritius. In what sectors did we attract this FDI? Computer and hardware, followed by services, and followed by trading. You just have to remember this trend as per economic survey. And the budget announced that there is IFSC authority. Basically, this financial services authority is actually bypassing all the regulators like RBI, SEBI, IRDA, etc., and will be dealing with the gift city in Ahmedabad directly. Recently, Deakin University of Australia announced that it will be setting up its campus in gift city of Ahmedabad. It is the first foreign university to be set up there, and you have to know that it is not under UGC regulations. The pros and cons, etc. analysis would be a part of the mains course, right? Not right now. In the capital account, after the investments, FDI and FPI, we're talking about debt. What do we have to know? Most of our debt is in US dollars, 55.5% as per economic survey, and the rest are in INR and other currencies. So we have to understand that most of our debt is external commercial borrowing, non-sovereign debt. That is, government did not borrow that. So here in this case, you have to understand an important concept called asset liability ratio and net international investment position. This ratios will give us an idea about India's overseas standing also. As far as NIIP is concerned, overseas assets that India has is given by this ratio. And this ratio is negative for India because we don't have so many overseas assets when compared to other foreign countries having their assets in our country. USA has the highest number of overseas assets. It's the first ranking country in this aspect. Next issue is the overseas direct investment. If Indians want to invest abroad, there are certain regulations. RBI regulates through the Foreign Exchange Management Act. The Ministry of Finance came up with certain no-go sectors where Indians can't invest, like real estate, gambling, and any financial products which are linked to Indian rupee because it can impact Indian economy also. Ministry of Finance also said that a no objection certificate will be mandatory for any person who has a bank account classified as a non-performing asset, or is labeled a willful defaulter by any bank, or is under investigation by a financial service regulator. Let's say, for example, you have Enforcement Directorate or the CBI. However, there is a time limit of 60 days. If the regulator does not give this NOC in 60 days, it is presumed that NOC is obtained by the seeker. In the post-globalization world, currency reserves are very important for India because any changes there can impact Indian economy. To handle this, IMF has a rule called the Guidati-Greenspan rule, which says that if we have enough reserves to fund at least 1 year's debt, that is enough. And Tarapur Committee, way back in 97, said that if we have foreign exchange reserves for 6 months of import, that is enough. Here is where the next important topic of internationalization of rupee is important. We want to make rupee a global currency. And the criteria for that is, out of all the global reserves of foreign exchange, rupee should have 4% share. Right now it is 1.6%, and therefore it is not an global currency. What this will do is it will reduce the currency risk. That is, let's say, for example, FPIs have left the country and therefore it led to the depreciation of rupee. That sort of things will not happen. And if other countries are directly accepting Indian rupees, that will also make exports competitive. So this is a potential question for this year's prelims. Last topic, WTO conference in Geneva and the outcomes. Not much happened on this front. There is an e-commerce moratorium which is continued till 2024. Basically, rich countries wanted to stop taxes on e-commerce. Countries like India and South Africa wanted to have this tax because they can tax e-commerce companies like Amazon and raise some revenue. But that has not happened. Secondly, there is an IPR waiver for COVID vaccines, meaning poor countries can access COVID vaccines at a low cost. Next thing is fishing subsidies. There are a lot of countries like Japan and even EU where fishing is becoming unsustainable, environmentally very dangerous. Therefore, they wanted to phase out fishing subsidies. But India did not agree to this and asked for a special and differential treatment. So, this is because India wants to promote blue economy in the untapped fishing sector and has a target of $14 billion marine products exports. We discussed that marine products are one of the the highest agricultural export products. Therefore, India did not agree for this. That is one issue. Nothing much to discuss apart from this. And finally, we have to talk about the IPEF, which is initiated by USA. We don't have to go into the details of this except for the fourth pillar where India did not agree to sign the fair and resilient trade agreement because it talks a lot about stringent labor laws, carrying out anti-corruption measures, etc., which are very, very disadvantageous to India. India did not agree to that. So this concludes the most important happenings in the external sector where you will be getting at least 8 to 10 marks, hopefully. So that's it for now. I hope you enjoyed this session. If you liked it, please like, share, and subscribe. Thank you.